I want to tell you about a quiet meeting that happened not long ago. The kind that doesn't make the front page, doesn't get a press conference, and most people will never hear about. A Gulf state, one of America's closest allies in the Middle East, one of the wealthiest nations on the planet, walked into a room with senior American financial officials and essentially said, "We need access to dollars, and we need it now." Not because they were broke, not because their economy had collapsed, but because the flow of oil through the waterway they depend on had been severely disrupted by conflict, and without that flow, the dollar revenue they count on to run their country had slowed to a trickle. And Washington agreed they had to. Now, I've been watching markets for 40 years. I've sat through Black Monday in '87, the Asian contagion in '97, the dot-com implosion, the financial crisis, the COVID crash. I've seen a lot of things that people called unprecedented. But what I'm watching right now is something different. It's not a banking crisis. It's not a recession, at least not yet. It's something more fundamental and frankly more dangerous in the long run. It's a trust crisis, a slow, grinding erosion of confidence in the architecture that has underpinned global finance since the end of World War II. And once that kind of thing starts, it is very, very hard to stop. So let me walk you through exactly what's happening, why it matters to you personally, your mortgage, your retirement account, your savings, and what I think you should actually do about it. Because there are things to do. This isn't a throw your hands up situation, but you have to understand the mechanism first. Let's start at the beginning. For about 50 years now, the United States dollar has occupied a position unlike any other currency in history. It is the world's reserve currency, which sounds like an abstract title, but has very concrete consequences. Here's what it actually means. When Japan wants to buy oil from Saudi Arabia, that transaction happens in dollars. When South Korea imports crude from Kuwait, dollars. When India buys energy from the Gulf, dollar. Nearly every barrel of oil traded anywhere in the world is priced and settled in US dollars. That's been true since the early 1970s, when a series of agreements locked in the dollar as the currency of global energy trade. Why does that matter? Because it creates an artificial, permanent demand for the dollar that has nothing to do with the American economy itself. Every country that imports energy, and that's most countries on Earth, needs to hold a reserve of dollars just to pay their energy bills. They're essentially forced to be dollar customers. And that demand is what has allowed the United States to borrow extraordinary amounts of money at relatively low interest rates for decades. Other countries need your currency, so they buy your debt, which keeps your borrowing costs down, which lets you spend more than you earn, essentially indefinitely. It's a remarkable privilege. The late French finance minister Valéry Giscard d'Estaing called it America's exorbitant privilege back in the 1960s. And he wasn't wrong. No other country gets to run deficits of this scale without eventually facing a currency crisis. The dollar's reserve status has been the safety valve. Now, here's where the dominoes start. The conflict in the Middle East, and I'm not going to pretend I know how or when it resolves, because nobody does, has done something economically significant. It has disrupted the flow of oil through one of the most critical shipping choke points in the world. The Strait of Hormuz, that narrow channel between Iran and the Arabian Peninsula, handles somewhere between a fifth and a quarter of all global oil and liquefied natural gas trade. When that strait gets dangerous, when ships stop moving through it freely, the countries that depend on exporting oil through it suddenly find their revenue evaporating. Think about what that means for a country like the UAE or Kuwait or others in the Gulf. These are nations whose government budgets, whose social programs, whose military expenditures are all funded by oil revenue. That revenue comes in dollars. When the oil stops flowing, the dollars stop coming in, and suddenly you have wealthy, stable, strategically important nations facing a cash flow problem, not an insolvency problem. They have enormous sovereign wealth funds, but a liquidity problem, a timing problem. They need dollars now, not in 6 months when the funds can be repositioned. And what did some of them do? They went to Washington and asked for currency swap lines. A currency swap line is essentially a short-term credit facility between central banks. Think of it like a trusted neighbor knocking on your door and saying, I need to borrow $500 until Friday. I know you know I'm good for it. I just need the float. The U.S. Federal Reserve has extended these lines to allied central banks before, most famously during the 2008 financial crisis and again during COVID. But the context this time is different because word got out that it wasn't just one country asking. There were several Gulf and Asian nations simultaneously requested dollar lifelines. That tells you something about the scale of the disruption. And it tells you something else, something that I think is actually more important, that these countries, in asking for this, also made clear that without dollar support, they might have to consider other options, including potentially settling some energy transactions in currencies other than the dollar. Now, I want to be careful here because this is where financial commentary tends to veer into breathless hyperbole, and I'm not going to do that. A few countries exploring non-dollar settlement in energy trade does not mean the dollar collapses next Tuesday. It doesn't mean the end of American financial supremacy. What it means is that the margin of tolerance is shrinking, the buffer is getting thinner, and the market is noticing. Because here's the thing about the dollar's reserve status. It isn't a law. It isn't written into any international treaty that can't be changed. It's a convention. It persists because it's convenient, because the alternatives aren't as liquid, because inertia is powerful. But conventions erode. They erode slowly and then suddenly. And the question I've been asking myself, and I think every serious macro investor should be asking, is whether we're in the slowly phase or whether we've quietly crossed into something faster. Let me tell you what the bond market is doing, because this is where I want you to pay close attention. This is the part that connects directly to your mortgage rate, your car loan, your retirement savings. A U.S. Treasury bond is, at its simplest, a loan to the U.S. government. You hand them $1,000, they give you a piece of paper that says they'll pay you back in 10 years, plus interest along the way. For 8 decades, these bonds have been considered the safest investment in the world. Not the most exciting. Nobody brags at a dinner party about their treasury holdings, but the safest, the bedrock. The thing you own when you want to be sure you'll get your money back. Foreign governments have accumulated enormous quantities of these bonds over the decades. Japan holds well over $1 trillion worth. China holds hundreds of billions. Gulf states, European nations, Asian central banks together, foreign governments hold somewhere in the neighborhood of $8 to $9 trillion of U.S. government debt. That's roughly a third of all publicly held U.S. Treasury securities in foreign hands. Now, when oil revenues dry up and dollar liquidity gets tight, what does the central bank do? It sells its most liquid dollar asset. And the most liquid dollar asset in the world is, you guessed it, U.S. Treasury bonds. This isn't ideological. It isn't a political statement. It's a treasurer doing their job. We need dollars, we have bonds, we sell bonds to get dollars. It's the most natural transaction in the world. But when it happens simultaneously across multiple large holders in a compressed period of time, the effect on the market is significant. In recent months, we have seen foreign central bank treasury holdings at the Federal Reserve at levels not seen since the early 2010s. China has trimmed its holdings to the lowest level in roughly 18 years. Japan, the single largest foreign holder of U.S. debt, has sold substantial amounts over a short period. The aggregate global selling of U.S. Treasuries in a recent 30-day window was, by some estimates, in the range of $200 billion or more. That is not a rounding error, and here is the mechanical consequence of that selling. The thing I need you to really internalize: bond prices and bond yields being the effective interest rate, move in opposite directions, always. This is not complicated, it just requires a moment of thought. Imagine you paid $1,000 for a bond that pays $50 a year. Your effective interest rate is 5%. Now imagine the price of that bond drops to $900 in the open market, but it still pays $50 a year. Now your effective interest rate is closer to 5.5%. The coupon didn't change. The price changed, and because the price fell, the yield rose. So when you get a massive wave of bond selling, foreign central banks, sovereign wealth funds, institutional investors all reducing their treasury holdings, bond prices fall. And when bond prices fall, yields rise. And when yields on U.S. government debt rise, every interest rate in the economy that's benchmarked to them rises with it. Your 30-year mortgage rate, your auto loan, business loans, corporate borrowing, the cost of financing data centers and factories and apartment buildings, everything. This is the transmission mechanism. This is how a conflict in a narrow waterway between Iran and the Arabian Peninsula puts upward pressure on your mortgage payment in Ohio or Texas or Florida. It isn't magic. It's a very logical chain of dominoes, each one knocking over the next. Long-term U.S. Treasury yields are currently around 5% and threatening to go higher. Some of the most serious macro analysts at major institutions, and I don't say this to frighten you, I say it because I think you deserve the honest assessment, believe we could see long-term rates reach 6% within the next 12 to 18 months if these dynamics continue. The last time we saw rates at that level for a sustained period was in the late 1990s. And that period ended with the dot-com collapse, a brutal 2-year equity bear market, and a recession. Now, I want to push back on a narrative you've probably heard. You've probably heard people say, the Federal Reserve controls interest rates. If rates get too high, the Fed will just cut them. Here's the thing, and this is something I spent my entire career watching play out. The Federal Reserve directly controls only one interest rate, the overnight lending rate between banks. That's it. They have indirect influence over short-term rates more broadly. But the long end of the yield curve, the 10-year Treasury, the 30-year Treasury, the rates that actually set your mortgage, those are set by the market, by the millions of buyers and sellers of Treasury bonds every single day. And right now, that market is saying rates are going up. And when the bond market disagrees with the Federal Reserve, in the long run, the bond market wins. The bond market is simply bigger. The bond market has more force. There's an old saying in finance, and I've said it myself to younger colleagues over the years, don't fight the bond market. The equity market gets all the attention, but the bond market is the adult in the room. It is larger, it is more rational over time, and it does not care about political narratives or Fed communications or anything else. It prices risk. And right now it is pricing an elevated risk in a sustained way. Let me connect this to the dollar itself, because this is the other dimension of what's happening when global demand for dollars weakens, when fewer countries are using dollars to settle oil trades, when central banks are diversifying away from dollar reserves, the value of the dollar itself tends to decline. The dollar index, which measures the dollar against the basket of other major currencies, has weakened meaningfully since late last year. We're talking about a decline in the range of 7 to 10%. That sounds modest. It isn't. A weaker dollar has two contradictory effects, and this is where most people get confused. On one hand, it makes American exports more competitive, which is theoretically good for certain industries. On the other hand, it makes everything you import more expensive. Energy, electronics, clothing, food ingredients. A significant portion of what Americans consume has an import component, and those prices go up when the dollar goes down. That's inflation, by another route. So you have a scenario where interest rates are rising, which typically cools economic activity and can push toward recession, and simultaneously inflation is being stoked, which typically requires higher rates to combat. The term for this uncomfortable combination is stagflation. It is the worst of all possible economic environments, and it is the one thing monetary policy is genuinely ill-equipped to handle, because raising rates to fight inflation makes the recession worse, and cutting rates to avoid recession makes the inflation worse. The Fed had to navigate a mild version of this in the 1970s. It was an extremely unpleasant decade for investors. I'm not saying that's definitively where we're headed. I want to be honest about the uncertainty. The war could de-escalate, oil flows could resume, central bank selling could slow. There are scenarios where these pressures ease, but the direction of the forces right now is pointing toward that combination. And I think it would be irresponsible not to say so clearly. Now, and this is important, I've spent a lot of this conversation on the risks, and I think you needed to hear them. But 40 years of doing this has taught me something else. Every environment, even a genuinely difficult one, has places where capital is rewarded. The question is knowing where to look. Let me tell you where I'm looking. First and most obviously, hard assets. Gold has always been the classic hedge against currency debasement, against the erosion of trust in financial systems, against the scenario where governments are choosing between inflating away their debt or borrowing more to keep the lights on, which, let's be honest, is exactly the choice that's on the table right now. Central banks globally have been buying gold at a rate that, by some measures, represents the highest sustained accumulation in decades. When the people who run the money printing machines decide they want to hold gold instead of the currency they print, that tells you something. It doesn't tell you the exact price tomorrow. Nothing does. But it tells you about the direction of institutional preference. Gold miners are worth looking at alongside physical gold for a different reason. When gold prices rise but mining costs don't rise as fast, the profit margins of gold producers expand dramatically. It's operating leverage working in your favor. I've seen this play out in previous cycles. The miners often lag the metal on the way up and then catch up sharply. That lag creates opportunity for patient investors. Commodities more broadly tend to perform well in inflationary, dollar weakening environments. Energy specifically. And I recognize the irony of recommending energy stocks given that an energy disruption is partly what's causing the problem. But the reality is that oil and gas companies, particularly those with low debt and strong free cash flow, are generating enormous profits in this environment and tend to continue doing so as long as the underlying commodity prices hold. Energy infrastructure is another category worth examining. Pipelines, terminals, storage assets that collect fees regardless of which direction commodity prices move. Banks, and this surprises people, can actually do reasonably well in a rising rate environment, at least up to a point. Banks borrow short and lend long. When long rates rise faster than short rates, that spread, called the net interest margin, the difference between what they pay depositors and what they charge borrowers, tends to widen. Larger, well-capitalized banks with diversified revenue streams are better positioned than smaller. Regional banks, which tend to have more concentrated exposure to commercial real estate and other rate-sensitive sectors. Now, let me tell you what I'd be cautious about and why. High-growth technology stocks, particularly unprofitable ones, or ones trading at very high multiples of future earnings, are highly sensitive to rising interest rates. Here's the intuition. When you buy a growth stock, you're essentially paying today for earnings that are going to materialize years or decades in the future. The higher interest rates go, the more you discount those future earnings, the less they're worth in today's dollars. It's called duration risk, and growth stocks have a lot of it. When rates rise sharply and unexpectedly, the valuation math on high multiple tech stocks can get brutal very quickly. I've seen good companies see their stock prices cut in half, not because their business deteriorated, but because the discount rate the market applies to future earnings shifted upward. Long-duration bonds in your retirement portfolio, meaning bonds with maturities of 10, 20, 30 years, are also vulnerable for the same reason. If you bought a long-term bond fund in the last few years expecting steady income and capital preservation, rising rates are working directly against you. This is not a new problem. It played out very painfully for bond investors in 2022. But the conditions that caused that pain haven't gone away. They may be intensifying. Real estate investment trusts, REITs, and utilities are two other categories that tend to struggle when rates rise significantly, because they're typically valued based on their dividend yield relative to the risk-free rate. When the risk-free rate goes up, those dividends look relatively less attractive, and capital tends to flow elsewhere. And I want to say something about the dollar itself. For anyone holding significant dollar-denominated cash savings, a sustained, meaningful decline in the dollar's value is, in real terms, an erosion of your purchasing power. Savings accounts and money market funds denominated in dollars will give you a nominal return. But if the dollar weakens 10 to 15% over a couple of years, while those accounts are yielding 4 or 5%, you're behind. Diversifying a portion of savings into assets that don't depend on dollar stability, whether that's gold, foreign equities priced in, other currencies, or commodity-linked investments, is something worth considering. Seriously, even if you've never thought about currency exposure before, Let me give you the honest philosophical piece. The thing I'd tell someone I actually cared about. The most dangerous thing a retail investor can do in an environment like this is assume that the way things have been for the last 10 or 15 years is the way they will continue to be. The last decade has been genuinely unusual. It was a period of very low interest rates, abundant liquidity, rising stock markets, and a strong dollar. That combination created an environment where almost any investment and almost any growth asset made money. Buying the dip worked. Holding through volatility worked. The tide was rising and most boats floated. That tide may be going out, and when it does, it reveals who was swimming naked. To borrow a phrase I've heard used more than once in my career, companies that only work in a low-rate world, valuations that only make sense with zero interest, rich borrowers who can only service their debt at current rates, not at rates 100 basis points higher. The investors I've seen navigate these transitions well over the decades are not the ones who got the timing exactly right. Nobody gets the timing exactly right. And anyone who tells you otherwise is selling something. The ones who came through well were the ones who asked consistently, am I being paid adequately for the risk I'm taking? When the answer was no, when assets were priced for perfection in a world that was increasingly imperfect, they reduced their exposure, not to zero, not into a bunker, but they tilted, they shifted, they built in some protection before they needed it. That's the posture I'd encourage right now. Not panic, not all in on gold and bunker supplies, but a thoughtful, deliberate look at your portfolio and a question, does this make sense if interest rates stay elevated for 2 or 3 more years? Does this hold up if the dollar continues to weaken? Does this survive if growth disappoints? The answers to those questions should shape what you own. I've seen a lot in 40 years. I've been wrong, sometimes badly. I've been right, occasionally quite well. But the times I've served my clients and myself best were the times I respected the signal the market was giving me, even when the narrative on television said everything was fine. Right now, the bond market is giving a very clear signal. The dollar is giving a signal. Central bank behavior, the actual revealed preference of the institutions that manage. National balance sheets is giving a signal. They are buying gold, reducing dollar exposure, and asking for liquidity lifelines. Those are not the actions of people who think everything is fine. And I think you deserve to know that. Thank you for watching. If this was useful, share it with someone who you think needs to hear it. That's all I ask.